Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The global bond sell-off deepens as rising oil prices fuel inflation concerns. Stocks and futures slide lower. The clock is ticking. President Trump warns Iran that time's running out to reach a deal, with the two sides remaining at loggerheads. Plus, G7 finance ministers meet in Paris as rising inflation threatens global growth. We'll speak to the French finance minister, Roland Lescure. Well, a very good Monday morning. It seems that the picture from Friday in markets continues this morning with yet more deadlock in the Middle East. Stocks extending their slide from record highs. So as you can see, red across the screen for equities and futures this morning, down 1% almost for Euro Stoxx 50 futures. And if you flip the board to the cross-asset picture, you can see why. We have oil higher for a third straight day. Brent up 1.75% to $111 a barrel. That fueling concerns around inflation and higher rates, and therefore yields higher. I've picked out the 30-year because the Treasury yield here is at its highest since 2023. 5.15 is where we are right now, but this is across the curve and around the world. The dollar, meanwhile, as the haven of choice this conflict, higher for a sixth day too. Now, what are the risk events on the agenda for today? At 7 a.m. London time, we will get EasyJet earnings. We'll also get RyanAir in just a moment. But in general, Europe's budget airlines bracing for the impact of surging oil prices as the Strait of Hormuz remains closed. We've also got a keynote speech from Elon Musk at the International Smart Mobility Summit, that at 8:20 a.m. London time. Today, we also have BOE speakers Megan Green and Catherine Mann. And in Paris, G7 finance ministers and central bank governors meeting against this backdrop of higher bond yields, also with a new Fed chair coming. Well, lots on the agenda. Let's set you up for the day ahead. We begin with breaking full-year earnings from RyanAir, the budget airline. How has it fared through the geopolitical challenges that have knocked most of its peers this quarter? Well, they're warning of rising costs this year if unhedged jet fuel prices remain at current levels, as they face higher bills for fuel, crew and aircraft maintenance. The red head here is that they see 2027 customers at 216 million, which is pretty much in line with the estimate. The full-year profit after tax beating estimates here, and more broadly saying that unit costs for the fiscal year of 2027 could increase by a mid-single-digit percentage, while the 20% of its unhedged fuel needs has spiked in price. Now, bear in mind that RyanAir's hedged 80% of its fuel at $67 a barrel for this year. That should insulate its earnings and give an advantage over other carriers, according to the airline. Of course, we've seen the shares more resilient than EasyJet's thanks to that strong fuel hedging, though, as you can see, over the past 3 months, the share's down 19%. Now, I'll be speaking to the CFO, Neil Sorahan. How cautious is he for the outlook ahead? Of course, RyanAir very exposed to a consumer downturn and that possibility that fuel shortages could ground planes, God forbid, this summer, as I think of my summer holidays. Now, let's turn to broader markets, shall we? Stocks in Asia extending their fall from record highs as bond yields surge on inflation worries. Let's check in with Winnie Xu in Hong Kong. Winnie, what are you watching where you are?
Yeah, good morning, Lizzie. As you mentioned, inflation story is back in focus once again. You have the MSCI Asia here down almost 1%, with oil rising for a third day, as you pointed out earlier, because of these lack of progress when it comes to the U.S.-Iran conflict. We're looking at Taiwanese stocks also tracking some declines from its U.S. peers from Friday. But earlier today, we did get a set of economic data from China for April, and overall, it was quite disappointing and pointing to a slowdown in the overall economic growth. Hence, you're looking at the Hong Kong and Chinese shares also losing momentum. Now, flip the board. I want to draw your attention to today's moves when it comes to the Kospi index. Very dramatic day again, with losses as much as about 5% earlier today at the open, but it quickly reversed these losses and now in the green with gains led by the Samsung Electronics shares. Now, the company's management management is now in negotiation with its largest labor union, and this is also raising optimism that they might be able to avert a strike, which the Prime Minister said that could have a significant impact on the economy. Now you flip aboard and take a look cross-asset, because overall Asian bonds also are tracking these losses when it comes to the global bond sell-off. You're looking at specifically Japan's 30-year bond yield now rising about 8 basis points, but earlier it did hit its highest level since 1999. Now overall, the rise in Japan's bond yields also reflecting the worries around the fiscal policy. Now with Prime Minister Takaichi also announcing extra budget because of these rising commodity prices due to the war in Iran. Back to you, Lizzie.
Winnie, thank you very much. That's Winnie Xu in Hong Kong. And that, of course, is a global story. Rising oil prices once again fueling this global bond sell-off, with the 30-year yield in the US hitting its highest since 2023. So let's go now to Bloomberg M Live strategist Mark Cranfield for more. Mark, are we just going to have to accept we're in a new era of higher rates and Fed cuts are off the table?
I think it's a little bit more serious than that, actually. It's beginning to feel as though the long end of global bond markets is actually becoming a bit unhinged. And once that starts to happen, policymakers lose. Central bankers are very focused on the short end of the yield curve, and there's a lot they can do there to try and calm things down with monetary policy settings. There's not too much they can do about the 30-year sector of the bond market. And once that starts to unravel, the implications just run across asset classes, and that's partly what Winnie was talking about in the earlier piece there. So it's now infecting equities, it's affecting commodities, it's affecting currencies. The whole gamut is coming into play here, and we haven't even talked about credit, which is often the next leg after you get disruptions in the fixed income market. It is becoming so serious here, investors will really want to hear something from this G7 meeting this week. Policymakers need to stand up and they need to get behind the bond markets and tell investors that things are going to be better. We're going to do a good job on managing our fiscal situation. That will promote some confidence back into the bond markets. That's not what we heard today from Japan. They decided that today would be a good day to announce an extra budget. Very poorly timed, in the sense that the bond market in Japan was already in a pretty weak setting itself. Still, they may all be able to backtrack a bit if the G7 people get their messaging right. But they really need to get a clear, supportive narrative coming out of these G7 meetings. Because what's happening now is that correlations are rising between bonds, equities, currencies, commodities. Once that happens, investors are just rushing for cash. Cash really becomes king again. When that is the case, no asset class will be immune at all. And we're in the early stages of it. If they don't start to speak in the right tone quickly, investors will take over. The bond vigilantes will be the ones who decide where it goes, and yields will go higher in the near term.
OK, a warning from Mark Cranfield, our Bloomberg M Live strategist. Thank you very much. And of course, our very own Chief Europe correspondent Oliver Crook will be on the ground for us at that G7 meeting in Paris. The finance ministers and central bank governors discussing the higher yields outlook. But let's turn now to part of the root cause of all of this. President Trump once again warning that the clock is ticking for Iran, with the two sides still far apart on any deal to end their war and reopen the Strait of Hormuz. In a Truth Social post, Trump said Iran had better get moving, or, quote, there won't be anything left of them. This comes as authorities in Abu Dhabi say a drone attack sparked a fire at a nuclear plant on Sunday, spotlighting the risks of the fragile ceasefire between Washington and Tehran. Joining me now in London, I'm pleased to say, is Jumana Basetchi, Bloomberg's Horizons Middle East and Africa anchor. Jumana, just walk us through how far apart are the two sides right now?
Yeah, Lizzie, good to be with you in London. Well, you know, it is a very different situation today than what we were talking about towards the end of last week. Remember, there were lots of hopes around the Trump-Xi summit that maybe we'd get a diplomatic breakthrough. That has not happened. And if anything, we're back to threats once again. President Trump overnight putting up that Truth Social post suggesting that the clock is ticking, time is ticking. He wants to see Iran sign on to a peace deal. And equally, over the course of the weekend, while we didn't get official commentary from Iran, we did get multiple Iranian media websites indicating that the U.S. had not made enough concessions in terms of what they were offering to Iran on the peace deal. So we're sort of back to where we were a couple of weeks ago, in that the U.S. are putting forward their list of demands. Remember that 10-point proposal. Iran are countering with their own max list demands, still very, very far apart. And then the question is, how do you break the deadlock? And it really does feel once again that there is a reasonable chance we could resort back to kinetic action. President Trump and Israeli Prime Minister Netanyahu had a phone call yesterday. He is due to meet with some of his security cabinet advisors. New York Times reporting on Friday that some limited military operations are once again on the table. It could be a specialized operation to go in and extract some of that enriched uranium. It could be a potential takeover of Kharg Island, or even once again renewed strikes against U.S. military infrastructure, Iranian military infrastructure. At the same time, over the course of the last 24 hours, there have been a few incidents in the region too. So of note, the nuclear plant in Abu Dhabi was hit by a drone. The UAE Ministry of Defense saying that it's unclear where exactly the drone came from, because it seemed to have come from the western part of the country, but still does indicate that many of these energy infrastructure sites are still targets. And overnight, Saudi Arabia also intercepting drones. So once again, the rhetoric seems to be escalating, but then also we're seeing renewed potential attacks on the UAE and Saudi.
Yeah, I feel deja vu. Seems a lot like where we started. Bloomberg's Romana Basechi, great to have you with us in London. Well, let's turn to China now. Growth slowing across the board in April, with investment resuming declines and retail sales rising just 0.2%. Booming exports no longer offsetting a disappointing domestic performance, it would seem, from the world's second largest economy. Joining me now is Alan Wong, Bloomberg's China economy and government editor, for more. Alan, good morning. Just talk us through this data. It seems pretty miserable out of China this morning.
That's right. It's a really sobering reality check for Beijing. We're seeing that Chinese consumers basically sat on their hands, with retail sales rising just 0.2% compared to the same period last year. The sales of things like cars plummeted 15%, and jewelry, gold, and stuff like that more than 20%. So it's really a bad reading in terms of retail sales, and it just means that the weakness in China's consumption continued and worsened. On top of that, investment also unexpectedly shrank, and that is just a reflection of the pressure from the higher oil prices, energy prices, and input material prices that are squeezing the profit margins in China's factories, making people hesitant to invest in new factories and other fixed assets. But there is one small bright spot here in terms of home prices. The price of new and resale home values fell less than before. In fact, in the gentlest pace in about a year. So that is the silver lining in the trade in the data released this morning. But the takeaway is really that China can no longer just rely on its export strength to keep the economy growing.
And Alan, Jemana was just walking us through the kind of disappointment on the US-China meeting in Beijing when it comes to the diplomatic efforts to end the Iran war. Have we had more progress on the trade front since Trump left Beijing?
There was some progress, but I would say none too surprising. Entering the summit, people like talking about the 3 Bs, Boeing planes, beef, and soybeans. They all more or less materialized, and China committed to buying $17 billion worth of agricultural goods from the U.S. every year, and that doesn't include the soybeans. And we've already seen the Chinese side moving to ease the import restrictions on U.S. beef producers, meaning that China will buy more beef from the U.S. So there's some progress here, but this is not surprising, and also the most important takeaway from the summit is that the U.S. and China look on track to just keep stabilizing their ties and to prevent their relations from deteriorating. For example, there 3 more potential meetings between Trump and Xi this year where they could hash out the details of those agreements. But before then, we already see them setting up some institutions to manage their ties, including a of Investment and a Board of Trade. And for the Board of Trade, it's tasked with figuring out exactly what's considered not so critical or sensitive that the U.S. might even ease tariffs on groups of Chinese exports. And for investment, it's also to manage what kind of sectors are not too sensitive for China to make investments in. So the broader direction of the relationship is going well. But then I have to say that there's also some potential wildcards in this relationship, mainly concerning the issue of Taiwan, because she made a very blunt warning to Trump that the U.S. should handle its dealings with Taiwan well. And if that goes well, then obviously these things that we talked about, the trade and investment, they can still go ahead. But then if there's a misstep here by anyone involved in that triangle, then we could potentially see downside risks to this relationship.
Okay, Alan, thank you so much. Bloomberg's Alan Wong, China economy and government editor. Well, still ahead on Daybreak Europe, global finance ministers meet this week to address lopsided foundations of growth in the wake of that US-China summit. French Finance Minister Roland Lescure will be joining us from Paris a little later in the programme. But first, we'll dig into the market outlook with Seema Shah from Principal Asset Management. That conversation next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:18 a.m. here in London. Rising oil prices are pushing stocks and bonds lower this morning as deadlock over the war in Iran fuels inflation concerns. Let's get analysis now. Seema Shah, Chief Global Strategist at Principal Asset Management, joins me now. Seema, good morning. We were just hearing from our MLive strategist Mark Cranfield, and he was painting quite a dystopian picture where the bond vigilantes are in the hot seat because of higher yields, creating headaches for every asset class from commodities to equities to credit. How worried are you about higher long-end yields just getting out of control?
Good morning, Lizzie. Well, I think the key thing that we've seen, at least since the start of the conflict, is that you've seen the bond market very concerned about the conflict, what the impact to inflation is going to be, how central banks are going to have to respond. And yet the equity market has been able to look through it and really focus a bit more on the tech side and continued underlying macro strength in key parts of the world. Of course, there is a risk that if the conflict extends and you see this continued rise in oil prices, then the bond yield side then becomes something that the equity market can no longer ignore. So it's almost a key transmission for the equity market to really sit up and take notice of the risks around the geopolitical crisis. So we have concerns. I think it's still quite early days. Really, the strength in the US, for example, from the economic numbers, but as well, of course, on the AI trade has been really key. So I think NVIDIA's earnings this week are going to be also really important to continue the quite positive market narrative for equities. But of course, in the next month or so, if you were to see this continue, inflation expectations continue to rise, then of course we do get into a slightly dangerous territory.
OK, because we did already see the AI rally wobbling a bit on Friday. You point out what a catalyst the NVIDIA earnings could be, but at what point do higher real yields challenge US equity leadership more broadly?
Well, look, it's always very difficult to draw a line in the sand of exactly at what point, what is the threshold where the market starts to be very, very concerned. Typically from a nominal side, the 4.5% level is always pointed out. But of course, it depends what the economic backdrop is, as well as what's driving it and what is the speed of the rise. I think right now, given the economics in the US has been very, very strong, stronger than people were expecting, that level is probably a little bit higher. But certainly you are seeing so much pressure on all parts of the curve right now that we're likely not too far off. But of course, very difficult to say exactly what that threshold is.
And of course, we're waiting for the gilt open here in the UK, Seema, but we have to talk about the politics that's happening, the leadership contest underway for the Labour Party. Investors talking about 6% yields on gilt if the political instability worsens. Do you see that as a realistic prospect as the markets keep pricing in prolonged fiscal drift, whatever government seems to come next?
Yeah, I mean, look, the UK is certainly in considerably more dangerous territory than you're seeing for other economies. Not only is it being exposed to the inflation risk, concerns about what central banks can do, everything that we've just been discussing with regards to global bond yields, but then of course it also has the local, the domestic political instability as well. Right now we're in a difficult period, trying to understand exactly what is going to happen with the Labour contest, leadership contest, and then of course what happens to fiscal rules. So I guess it's difficult to say exactly, again, what that peak level is, but certainly the UK is facing significantly more challenges than you're seeing for other global bond markets.
Yeah, you just wonder if we're in a doom loop where you've got weak growth, rising borrowing costs, and then this political fragmentation all reinforcing each other. Some talking about the UK being ungovernable. Is that hyperbolic to you?
Well, so Lizzie, you and I have spoken about this many times over the years, and I think you've heard me use the doom loop narrative for the UK in many ways. Where we go from here, I think is very difficult. The UK over the last couple of years has pushed itself into a level where, from a fiscal side, there is very little way out. And unfortunately, when you're in that position, having political stability is very difficult. I mean, I think from the bond market's perspective, what they want is quite clear. They want to have they want to know who the government is going to be, not just for the next few months, but they want to know who the government is going to be for the next year or two. They also want to know that there is commitment to the fiscal rules. I think once you've got that pinned down, then we can think about the economics. What is the UK going to do to improve productivity gains? Because, of course, over the long term, the UK is one of the few countries which has got a deteriorating long-term growth rate, not a rising one. So the UK is confronting so many challenges right now. The last thing it needs is this domestic political instability to be piled on top.
Yeah, and the international instability on top of that. Seema, thank you so much, as always, for your analysis. That's Seema Shah, Chief Global Strategist at Principal Asset Management. Well, coming up on the programme, the World Health Organization declares a public health emergency as an outbreak of Ebola kills dozens of people in Congo. That's next. This is Bloomberg. Now to some of the top stories we're following for you this morning from around the world. The World Health Organization has declared an Ebola outbreak in the Democratic Republic of the Congo and Uganda as an emergency of international concern due to cross-border spread. The outbreak is caused by a rare virus strain which has no approved vaccine or treatment. The WHO is urging funding, coordination and emergency response efforts rather than restrictions to travel or trade. Meanwhile, here in the UK, continued political uncertainty is sending sterling a little lower this morning after former Health Secretary Wes Streeting said that he will run in any leadership contest to replace Prime Minister Keir Starmer. Streeting also used a speech to call for the UK to eventually rejoin the European Union, putting Brexit back in the spotlight as potential leadership rival Andy Burnham prepares for a by-election battle to return to Parliament. And Spain's ruling Socialist Party has suffered its worst result ever in Andalusia, the country's biggest region. The opposition People's Party held on to power despite losing support as well. Prime Minister Pedro Sanchez had hoped to rebuild backing in the traditional socialist stronghold by fielding a former finance minister. Well, those are some of our top stories in geopolitics this morning. And coming up, G7 finance ministers meet against a volatile global backdrop. We'll be speaking with the French finance minister next. That conversation with Roland Lescure coming up for you. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The global bond sell-off deepens as rising oil prices fuel inflation concerns. Stocks and futures slide lower. The clock is ticking. President Trump warns Iran that time's running out to reach a deal, with the two sides remaining at loggerheads. Plus, G7 finance ministers meet in Paris as rising inflation threatens global growth. We'll speak to French Finance Minister Roland Lescure. Well, a very good morning. Welcome to the programme if you are just joining us. 6:30 a.m. here in London. And as you can see, it is red across the screen for stocks and futures this morning, extending the slide from record highs. And this is a continuation of the story that we saw on Friday, with yet more deadlock in the Middle East. So down nearly 1% when it comes to Euro Stoxx 50 futures. And if you flip over to the cross-asset picture, you can see why. Brent is higher again today, up 1.8% at $111 a barrel, so higher for a third day here. That fueling inflation concerns and worries about higher rates, and therefore yields higher. The 30-year at 5.15 there on treasuries. But this is across the curve and around the world. But that 30-year yield I pick out because it's the highest since 2023. The dollar, though, meanwhile, the haven of choice throughout this conflict, higher for a sixth day too, up just a touch on the Bloomberg Dollar Spot Index. Now, let's turn over to our front pages this morning. We start off with the Financial Times. They're reporting on potential Labour leadership candidate Andy Burnham playing down the prospect of the UK rejoining the European Union. That's, of course, after the former Health Secretary and fellow leadership hopeful Wes Streeting called for Brexit to be reversed, so potentially throwing a spanner in the works for Burnham's by-election. Turning over, though, to the Wall Street Journal, they say that Apple, which has long been revered for its premium-priced products, has been making high profits by using chips with slight defects that might otherwise have been thrown out. And Les Echos out of France leads on the mega acquisition by Publicis of the ad tech company LiveRamp, the paper describing it as a new turning point in the history of Publicis. Well, you can get a roundup of all the stories that you need to know to get your day going in today's edition of Daybreak, which terminal subscribers can go to find at DAYB Go. Well, we have global finance ministers, meanwhile, gathering in Paris this week, looking to address the structural imbalances undermining world growth following Trump and Xi's summit in Beijing. Our chief Europe correspondent, Oliver Crook, I'm pleased to say, joins us now from Paris. And Ollie, you've got a special guest with you.
Yeah, that's right, Lizzie. Thank you so much. We're here at the G7 finance ministers meeting at Bercy at the French finance ministry. We're very pleased to be joined by the French finance minister himself, Roland Lescure, who joins us and is chairing this meeting today of the G7. So thank you so much for taking the time.
Thanks for being here.
Of course, the elephant in the room, the main economic story of the year is the war in Iran, the consequences that has had for, obviously, energy prices, of course, economic growth. What scope is there at the G7 level to work collectively to sort of dampen some of the pain there?
Well, one, it's happening. And as you know, the G7 has always been the place in hard times where we engage and we talk. And the fact that it's happening here, I think, is a pride for me and very important for all of us. We're going to talk about the impact on the economy, on the bond market, on inflation, on flows as well, and including for most vulnerable countries, fertilizers, raw materials. This is a major deal for all of us. But in Africa, the cropping season is taking place. We want to make sure that the G7 sends a message. One, we're in charge. We're following things. We're acting if necessary. We released strategic reserves of oil a couple of months ago, and if need be, we'll do it again in the future. We are in charge. We're following the situation. We're also thinking of the most vulnerable nations, which we need to be helping.
So breaking down the very many dimensions in which this war is having a sort of an impact across the world, in terms of the European economy, for example, the conversation we keep having with ministers is about this idea of stagflation within Europe. How sort of afraid are you, how worried are you about the stagflationary dynamic?
I mean, obviously I'm preoccupied, and who wouldn't be? But the message I want to give the auditors is so far so good. I think the economy is proving quite resilient. As you know, the European economy is not that exposed to the volume part of the shock. It's a price shock, for sure, on oil, on gas, and other commodities. But so far, there's a slowdown. But there's no recession, so no stagflation. And inflation is on the rise, but we haven't seen, thank God, in a way, any second-round effect either. So less growth, more inflation. But so far, we're not in a recession, and we're not in a high inflation. It has to be monitored Central bankers are going to be here today and they're probably going to be telling us that, but so far so good.
And one place where things may not be so far so good, we're starting to see indications of is within the bond market. Global yields rising, across the world. We're seeing a lot of different sort of red indicators. You've obviously worked in the world of finance, so you're looking at the bond market. What is the bond market telling you right now?
Well, it's telling us that there's a high uncertainty on both fronts. Well, on three fronts actually: growth, inflation, and public finance. And this is the main reason why we in France decided to be very nimble with our budgetary response to the crisis. We've put money, not much money, very targeted on the sectors that are highly on the front line: farming, fishing, transportation. But for all of that, for all of the other sectors, we feel that we are better protected because of our energy mix, we're less exposed, and therefore we should make sure that we're nimble with our public finance. The public euro is rare, so it should be used scarcely. And I think this is probably, in a way, the signal that the bond market is telling us. Guys, make sure that you react without, going too far down the budgetary line, because we know it's a supply side shock. You cannot deal with a supply side shock by subsidizing demand. That doesn't work.
But looking at sort of dashboard of all the sort of data, obviously we have two wars going on that have massive impacts on the global energy markets. We have yields and we have interest rates likely going to rise in Europe and across the world. In part as a consequence of that, you have at the same time, borrowing costs rising. You have at the same time fiscal space is just not where it used to be. Don't you see the potential here for all of the ingredients for something disorderly to happen, and at the same time equity markets vertical in the United States?
Thanks for lifting my spirits. But this is exactly why we're here. This is exactly why we need to engage and discuss all of that, to make sure that we exchange on the best practices and the things we shouldn't do, to engage with the central bankers so that they can tell us what they're going to be looking for in order to avoid second-round effect. I mean, this is a time where, as you said, risks have risen. And when risks are rising, we need to make sure that we, as drivers of the global economy, we're not the only ones anymore, which was the case in the 70s when this was created. We have our eyes on the ball and making sure that we're doing the right things, because we can't do the right things. Coordination, engagement, nimble public finance, targeted help, and obviously, hoping that the resilient economy will still proven. At the end of the day, the main challenge is to reopen the Strait of Hormuz. We know this. Hopefully it's going to happen soon.
So what do you need to know from Scott Bessent, who I understand you spoke to yesterday? You'll be speaking to, obviously, over the next couple of days. What do you need to know from the U.S. administration?
How did the China trip go? Obviously, we're very interested in the way the conversation between China and the U.S. is. I think he's convinced, at least the conversations I've had with him have tended to show me that this is open, this is important. What's happening here, the fact that we can engage on global imbalances, on raw materials and critical minerals, on the help that we can provide with developing countries faced with that crisis, and on the crisis itself, we can engage, we trust each other, and I think we've built over the last 6 months a good enough relationship that we can say that. We're going to see, hopefully we'll have a communique that's going to send a signal to the world and to the markets. And then, we need to keep on working. We need to keep on working because the job isn't done yet.
And what place in that communique would you like to see the issue of critical raw materials play? Because obviously there's a number of initiatives. You have the Pact Silica by the United States, which the EU is now, I understand, considering joining. Do you think that is a valid initiative? And is that just basically an anti-China?
There are three things. No, it's not just about being against China. I mean, obviously China, weaponized raw materials a year ago, and this shouldn't be the case. But the best way of addressing this is to have a diversified supply chain. So the way we are seeing critical raw materials discussions here is threefold. One, to make sure that we understand and follow the markets. This is what the IEA has been doing since the 70s, and we're in a bit of a similar situation. Two, have potential agreements in which we agree as nations to work together in making sure the market works. But three, even more importantly, we need to show that on the ground things are happening, that projects are rising from the ground up to extract, to refine, and to build magnets. There's great projects. There's one in the southwest of France where French, US, and Japanese capital is financing a French factory that's going to refine and reutilize rare earth to export to Japan. This is multilateralism on the ground that seems to be working. We need to show the world that we can work together to address those critical issues of electrification.
And I want to ask you also a question about the French economy, because we've had a number of data points over the last week or so. We saw unemployment unexpectedly rise to, I think it's 8.1%. Inflation is now at 2.5%, which is in European terms relatively subdued, but by French standards quite high. Yields rising. What is the French economy telling you? Is there a risk of recession, do you think, in France?
No, so far, obviously, the French economy had a break in the first quarter, and I think it's going to bounce back in the second for kind of statistical reasons. But at the end of the day, what I said about the European economy earlier is even truer of the French economy. So far, we have been resilient. We are heading face winds, obviously the shock, the oil price, the gas price and all. But because of the energy mix, that's better than anywhere else. We're better protected, less exposed. Because of automatic stabilizers of the French economy, the French social model, it's got its flaws. But minimum wage is going to increase automatically on June the 1st, 300% altogether from January, since last January. So we have our social automatic stabilizers that are proving the economy to be more resilient in terms of shocks. So we'll see, but my expectation is 0.9% growth this year. The consensus are at 0.8. This is not recession, far from it. So let's hope for the best.
And in sort of ordinary times, if we can call it, if we have access to those, we might be talking a little bit more about AI here, the kind of concern that it has on the global stage. There's, of course, this Mythos model that is a high concern for the finance industry. And we understand Mistral has come out with a sort of version of it. What can you tell us about that? How important is it for French finance to have access to that?
It's very important for us to understand this, and we're probably going to address that also during the next couple of days with my G7 finance colleagues. Cybersecurity of our finance industry is very important. We need to work on that. We also need to make sure that we embrace AI as an opportunity as Europeans. And Mistral AI, you've mentioned it, is a great way for France and Europe to show that we can be on that map. So embrace the opportunities, be aware of the risks and manage them collectively, because at the end of the day, our financial markets are so integrated that we need to manage them together. Again, this is a great tribute to what's going to happen in the next couple of days here.
Well, Roland Lescure, thank you so much for your time. They're the French Minister of Finance who joined us here at the G7 Finance meeting, the meeting that he'll be chairing. So we'll be hearing from a number of finance ministers from across the world and, of course, the central bankers as well.
OK, Bloomberg's Oliver Crook on the ground for us. Thank you very much for bringing us that interview. And, of course, Ollie will have full coverage of that meeting for us throughout the week. But coming up on Daybreak Europe, the limited edition pocket watch collaboration that led to this scene outside a Swatch store in New York. We'll get you the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:45 a.m. here in London. Now to our top corporate news this morning. The Information is reporting that BlackRock is looking at investing $5 to $10 billion in SpaceX's initial public offering next month. Bloomberg has previously reported that SpaceX has confidentially filed for its IPO and seeks to raise as much as $75 billion at a valuation exceeding $2 trillion. That'd make it the largest IPO of all time. Elsewhere, Swatch has been forced to shut stores and cancel launches of its Audemars Piguet pocket watch collaboration after massive crowds raised safety concerns. The Swiss watchmaker shut nearly 20 stores throughout the US and on Saturday and cancelled events in the UK, France and other locations, urging customers not to rush to stores. New York police reported one person was arrested outside the Swatch location in Times Square. And Publicis has agreed a deal to buy US-based data collaboration platform LiveRamp as part of the French company's push to accelerate investment in AI tools. The deal values the US company at $2.2 billion, a 30% premium to Friday's closing price. So that's some of our top corporate news this morning. And coming up, we shall turn to earnings. The RyanAir CFO, Neil Sorahan, on the company's latest results and how the airline is dealing with soaring fuel and energy prices. That conversation next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just checking in on the futures picture, and the clouds are clearing somewhat when it comes to European stocks 50 futures, but we are firmly in the red across the world for stocks and futures this morning. This as they extend their slide from record highs, and it comes as a result of the deadlock continuing in the Middle East. Just flipping over to the cross-asset picture, and you can see the root of all of this, really. Brent here actually pairing some gains at $110 a barrel now, but that elevated level really fueling concerns around inflation and higher rates. That is why we have yields higher, for example, on the US 30-year, now at its highest since 2023. 514 is where we trade at the moment, but that across the curve and around the world, including when we look at the long end of Japanese yields, we are higher, and waiting for the gilt market open in the UK as well. Of course, we factor in the political instability on top of that. Now, it's been a busy morning for earnings when it comes to RyanAir. We're also waiting for EasyJet earnings on Thursday, but RyanAir in particular warning of rising costs this year if unhedged jet fuel prices remain at current levels. This is the Irish budget carrier faces higher bills for fuel, crew and aircraft maintenance. The company's full-year profit after tax came in ahead of estimates, though, and I'm pleased to say the CFO, Neil Sorahan, joins me now. Good morning to you, Neil.
Lizzie, how are you doing?
Very well, thank you. I wonder how you're doing with this Middle East war on. It really has been impacting airlines across the space. What's your big message to shareholders this quarter?
Well, I suppose the first thing you just referred to, we're coming off a record year profitability, record traffic, and we're particularly well hedged into the current financial year. We've got 80% of our jet fuel hedged at $668 a metric tonne, which is down from $760 a metric tonne last year. Those hedges run out to the back end of March 2027. So we're in a very, very strong position. We plan to grow by another 4% to 216 million passengers, having got the last of the game-changer aircrafts in February just gone, and we're getting very excited about the MAX 10 aircraft starting to come in the spring of next year. So RyanAir is very much operating as normal, despite the challenges from the Strait of Hormuz being closed to traffic at this point in time. I mean, sorry, Lizzie, go ahead.
You have said, though, Neil, that your fuel bill's risen by a few $100 million. Yeah. How are you mitigating the impact of that, then? Because other airlines have talked about hiring pauses, cuts to discretionary spend. Are you going to have to do anything like that?
Well, RyanAir already has the lowest cost by some significant distance. If you were to look at the cost gap advantage that we had compared to our nearest competitors pre-COVID, there was about a €26 per passenger gap with Wizz pre-COVID. That's now over 70%. There was a 70% gap with EasyJet. That's now over 150%. So RyanAir has the lowest cost. That cost gap's going to continue to widen for some time to come. We're locking in very attractive jet fuel hedging into the current year. But yes, you're right. I mean, if jet fuel prices remain at the current levels, our 20% unhedged is going to be significantly more expensive than it was last year. But we're in a position now where we're paying down the last of our debt. So next week, RyanAir becomes debt-free. We're not taking on expensive new debt. We're not taking on expensive new leases, unlike our competitors. We're moving capacity around Europe, where governments are stimulating growth and removing municipal taxes. So we're doing great long-term airport deals, which is helping to offset some of the short-term costs. And then when you look into next year and beyond, we start taking the MAX 10 aircraft. These are 20% more fuel-efficient aircraft. These are 20% larger aircraft. They've got full warranties, so it helps bring the maintenance costs down and spread the costs over more passengers. So RyanAir is going to have a very strong year, regardless of what happens in FY27. It just might not be as strong as last year.
Yeah. Well, on the consumer booking side, I wonder how behaviour's changed in this environment, what the demand outlook looks like for the rest of the summer. What's the trajectory for fares as well?
Yeah, well, demand remains very strong. I was just looking at my weekend bookings there before I walked onto set. We'd over 1.7 million people booking flights with RyanAir. So no shortage of people keen to get flights locked away. At this point in time on Q1, and much of this is down to the timing of Easter, we think fares will be down mid-single digit. This is the June quarter, and a lot of that's due to the fact that fares were up 8% in the quarter just ended, where the first key week of Easter fell in there. We had a full Easter in the prior year comp. On the peak summer months, visibility isn't as good as it typically would be at this time of year. So at this stage, having originally thought that fares would be up a couple of points when we were setting our budget, fares are trending broadly flat, but that doesn't mean that close-in fares won't go up. So my strong message to you and all of our viewers is that they should book their flights at RyanAir.com as quickly as possible to avoid high fares.
All right. Well, let's just talk about consolidation as well, Neil, because we've seen moves in the US with the likes of United, American, Spirit. Yep. What consolidation do you see happening here in Europe? What M&A are you in the market for? Yeah,
well, I mean, there's a lot of M&A ongoing at this point in time. We're seeing Lufthansa increasing their stake in ITA to 90%, subject to competition approval. We've got TAP, the Portuguese flag carrier, up for sale with strong interest from Air France KLM. And of course the Lufthansa group, who will be putting in binding offers in the not too distant future. And then there's a lot of weak carriers in the market who I think may manage to trade through the summer, unlike Spirit in the United States, but will get into serious difficulty in the ever difficult December quarter, where cash flow starts to increase and revenue starts to fall. So I wouldn't be surprised to see some airlines getting themselves into difficulty this winter, potentially one or two going to the wall.
Just finally, you've mentioned the Boeing MAX 10s. Are deliveries still on time for this year? Do you see any risks to that timeline?
Yeah, Boeing are continuing to expect certification within 2026, possibly towards the back end of the summer, the early fall. So that means, and they've confirmed in writing to us, that the first of the MAX 10s will start delivering to RyanAir in the spring of next year. So we would hope to have 15 of these aircraft available for summer of 2027. So all of our plans now are not around will we get them. All of our plans are around when we get them and entry into service exercises. So very excited. 20% more fuel efficient, 20% more seats, so we can spread the costs over even more passengers and widen that cost gap between RyanAir and everybody else with these aircraft.
Neil, as ever, always great putting the flesh on the bones of the earnings with you. Our RyanAir CFO, Neil Sorahan, thank you very much for making time for us. Let's just look at the risk events on the docket for the week. Wednesday, really the highlight. We've got UK CPI for April coming out, Fed minutes on the same day, and Nvidia earnings, potentially the big catalyst for the week. But coming up later today, Bloomberg's live from Dell World in Las Vegas, and our very own Ed Ludlow will be speaking exclusively to the CEOs of Dell and Nvidia. So that conversation from 7:30 p.m. London time, one you won't want to miss. Coming up next, though, the opening trade. Anna, Guy and Tom will take you all the way to the market open. So stay with us. This is Bloomberg.